DMCI Holdings Incorporated is a leading Philippine conglomerate active in construction, mining, power, real estate, and utilities. Its core businesses include construction, DMCI Incorporated, coal mining and power generation, Semirara Mining and Power Corporation, nickel mining, DMCI Mining, residential real estate, DMCI Homes, off-grid power, DMCI Power, water utilities, Subic Water, and Manila minority stakes, and now cement manufacturing, CEMEX, rebranded as Concreate Holdings. As a diversified engineering conglomerate founded by the Consunji family, DMCI is known for landmark infrastructure projects, over 1,000 completed, and as the Philippines' first quadruple-A top-rated contractor. This mix of businesses makes it a barometer of Philippine infrastructure, energy, and property markets. Construction. DMCI Incorporated is one of the country's largest builders, responsible for major projects like hospitals, malls, and airports. It boasts thousands of projects since 1954 and holds a PCAB quadruple-A rating. In 2024, DMCI Construction generated around 15.0 billion pesos in revenues with 467 million pesos in net income. Its large backlog of government and commercial contracts provides steady workloads. Real estate. DMCI Homes is a top mid-market condominium developer. It pioneered resort-style, Lumavent, high-rises in Metro Manila and key cities. By end 2024, DMCI Homes had around 12.3 billion pesos in revenues and 2.8 billion pesos in net income. Recent reports highlight booming demand. In Q1 2025, ready for occupancy, RFO, condo sales jumped to 503 units, 3.57 billion pesos, from 277 units, 1.74 billion pesos, a year earlier. DMCI Homes' strong pre-sales and rent-to-own program suggest housing demand is holding up well. Coal and on-grid power. Semirara Mining and Power, SMPC, 56% owned, is DMCI's largest earnings contributor. It produces coal on Semirara Island and operates a 1,203 megawatts power plant, with cogeneration to Lucio Tan cement plant. SMPC's coal dominates DMCI's sales, nearly 30% of first half in 2025 consolidated revenue. However, weak global coal prices, Newcastle Index fell around 26% year-on-year in Q2 2025, have cut SMPC's profits. For Q2 2025, SMPC contributed only 2.3 billion pesos profit, down 32% year-on-year, partly due to softer coal sales and an equity loss in the cement unit. Management notes energy market stabilization, but no near-term upswing yet. Off-grid power. Through DMCI Power, the company runs 159 megawatts of diesel and renewable plants serving off-grid areas, such as Palawan, Mindoro. This division is the country's largest off-grid generator. In 2024, DMCI Power delivered 491.2 gigawatt-hour, up 9% year-on-year, and has 27% more capacity coming, 12 megawatts wind, plus new bunker and diesel units. It generated about 1.26 billion pesos net income in 2024. In Q2 2025, DMCI Power's profit was 374 million pesos, up 5% year-on-year, on higher sales and new wind capacity. Off-grid power is a growth area for DMCI, with relatively stable demand, even if tariffs adjust with fuel prices. Nickel mining. DMCI Mining, DG Nickel, exploits nickel or stockpiles in Palawan and Zambales. This segment has been ramping up under long-term offtake deals. After a loss in early 2024, DMCI Mining swung to a net 409 million pesos profit in first half 2025, 344 million pesos in second quarter, as sales recovered. Management says DMCI Mining will add 2 new mineral production sharing agreements, new mines, in 2025 to boost volumes. A joint nickel Asia processing deal is also in the works. Water utilities. DMCI has a controlling stake in Subic Water and minority positions in Maynilad, around 25 to 27%. These regulated utilities provide stable earnings. Notably, Subic Water, 30% DMCI stake, significantly increased its net income in 2024 to 291.4 million pesos, up from 26.4 million pesos in 2023, thanks to efficiency gains. Subic's franchise was extended to 2047, securing long-term cash flow. DMCI's share of Maynilad's profit also grew. In Q1 2025, DMCI's portion of Maynilad profit jumped 39% to 926 million pesos. Lastly, cement. In December 2024, DMCI Consortium, with MPIC and GIC, acquired Cemex Asia Pacific, Cemex PH, for around $272 million, rebranding it Concreate Holdings. Concreate now operates 2 cement plants, supplying aggregate and cement. This marked DMCI's entry into heavy building materials. However, the business is currently loss-making. It posted a net loss of 546 million pesos in Q1 2025 due to startup costs, low volumes, and interest. The acquisition adds diversification, with major brands like Republic Cement, but also integration costs and goodwill burden in the near term. According to DMCI's published results, annual revenues and profits peaked in 2022 and have fallen since. For year 2024, consolidated revenues were 102.38 billion pesos versus 122.83 billion pesos in 2023, down 17%, and net income was 18.98 billion pesos versus 23.72 billion pesos, down 21%. This slide largely reflects weaker commodity prices and a slowdown in construction activity. For Q2 2025 alone, revenue was 29.74 billion, up around 6% year-on-year, but net income only 4.02 billion pesos, down 27%. The first half of 2025 shows a similar pattern. Revenue is 61.60 billion pesos, up 11%, but net income is 9.13 billion pesos, down 18%. Segment performance. The coal power segment, SMPC, remains the single largest income source, but its profit plunged around 32% year-on-year in Q2 2025. Real estate, DMCI Homes, and off-grid power held up. DMCI Homes earned 678 million pesos, down 8% year-on-year in Q2, and DMCI Power earned 374 million pesos, up 5%. Water Maynilad was a bright spot. DMCI's share jumped to 973 million pesos in Q2, up 33%. Nickel mining recovered strongly. It swung to a profit of 344 million pesos from a loss. Construction output plunged. DMCI profit was just 18 million pesos, down from 250 million pesos in Q2. This is due to higher costs and delays. The new cement unit, Concreate, is hurting earnings, 682 million pesos loss in Q2. In sum, water, nickel, and power growth partially offset weakness in coal and construction this quarter. Key ratios and indicators. Earnings per share, EPS, has declined from 0.84 pesos in early 2024 to 0.69 pesos in first half of 2025, reflecting the profit drop. The annualized return on equity is about 15.9%, which is solid for a conglomerate. Balance sheet metrics remain healthy. As of mid-2025, net debt to equity was only about 22.3%, slightly down from 22.6% a year ago, thanks to debt repayments and steady cash generation. DMCI maintains a conservative policy. In March 2025, it declared dividends of 60 cents per share, total of 7.97 billion pesos, equal to 42% of 2024 core net income. This well exceeds the minimum 25% payout rule. Historically, The company paid 1.44 pesos per share in 2023 and 1.20 per share in 2024, 66% of 2023 earnings. At recent share prices, 10 to 11 pesos, the forward yield is on the order of 10 to 11%, a relatively high income stream by local standards. Capital expenditures and outlook. DMCI is investing heavily. In first half of 2025, the group spent 23.5 billion pesos on capital expenditures, up 19% year-on-year, mainly on mining equipment and new power plants. Excluding water projects, capital expenditure was 12.7 billion pesos. Planned projects include new coal equipment, Semirara, expansion of off-grid capacity, wind and bunker plants, and 2 new nickel mines slated for 2025. DMCI's 2025 guidance continues to anticipate higher revenues in energy and power, offsetting transitional drag in coal and cement. Cemex, or Concreate acquisition. In December 2024, DMCI, with partners, completed the $272 million purchase of Cemex Holdings Philippines. The unit was rebranded Concreate in April 2025. This entry into cement and aggregates gives DMCI exposure to the construction materials market. However, Cemex, or Concreate, is loss-making on startup. DMCI absorbed a 546 million net loss in Q1 2025, and a goodwill of around 1.9 billion pesos will have to be justified by future scale. Management says integration will take time, but this move diversifies the portfolio. Off-grid power expansion. DMCI Power continues to grow its off-grid footprint. In 2024, it commissioned new plants in Palawan and Antique, wind and bunker fuel. It plans around 43 megawatts of added capacity, 27% increase by 2025. These projects should boost future earnings and cash flow. Water utilities. Subic Water's 20-year franchise extension until 2047 was approved, solidifying that investment's future returns. DMCI, with 30% ownership, sees strong upside as water demand grows in Subic. The company was also part of a consortium vying for a minority stake in 2023, reinforcing its focus on Philippine utilities. Mining projects. DMCI Mining is opening new nickel projects and is exploring partnerships, such as Nickel Asian processing. 2 new nickel mines are set to start in 2025. These moves aim to replicate the success in Masbate and tap the Philippines' nickel exports boom. Construction and infrastructure. DMCI's construction arm has one of the largest order books in the country, around 40.6 billion pesos at end 2024. It is bidding on big government contracts, transport, utilities, flood control, under Marcos's Build Better, More program. Infrastructure spending. The Philippine government is dedicating record budgets to infrastructure. For year 2024 budget set 1.51 trillion pesos for infrastructure, around 5.7% of GDP, up 13.5% from 2023. The proposed 2025 budget is around 1.507 trillion pesos. Yearly infrastructure outlays have climbed from 989 billion pesos in 2020 to 1.51 trillion pesos in 2024. DMCI, with its construction expertise and new cement arm, should benefit from sustained public works and P projects in roads, railways, airports, and water. Energy and commodities. Global coal prices have cooled from their 2022 highs. In Q2 2025, Semirara coal sold for around 2,223 pesos per metric tons versus 2,780 pesos per metric ton a year ago, mirroring a drop in Newcastle Coal Index from $136 to $100. For now, power prices in Mindanao and off-grid fuel costs keep margins thin. Meanwhile, oil prices and peso swings effect on grid power tariffs. DMCI's diversified energy mix, coal plus diesel and renewables, means it partly hedges these trends, but subdued coal and power prices have dented its 2024 to 25 profits. Nickel prices have been volatile too, but Philippine nickel ore remains in demand for Chinese stainless mills. Housing market. The local condominium market shows mixed signals. DMCI Homes strong Q1 2025 sales. RFO units sold. Rising home rental interest suggests resilient demand at its mid-market price points. However, higher interest rates and supply gluts in some cities could constrain real estate growth. DMCI's focus on RFO and flexible rent-to-own schemes positions it well if buyers become more cash-sensitive. Utilities and water. Rising population and urbanization keep demand steady for power and water. Reforms, such as strengthened PPP law, may accelerate private investments in energy and water infrastructure, potentially creating new opportunities or competitors for DMCI's units. Reasons to buy DMCI. Diversified cash flows. DMCI spans multiple growth areas: infrastructure, housing, energy, mining, water. Weakness in one segment is often offset by others. For example, in Q2 2025, losses in coal and cement were cushioned by gains in water, nickel, and off-grid power. Attractive yield. The stock offers a relatively high dividend yield, on the order of 10 to 11% historically. Management has consistently paid out well above the 25% policy, 42% of 2024 core net earnings. This makes it a good income play in the otherwise low-yield Philippine market. Infrastructure tailwinds. Strong government infrastructure spending, 1.5 trillion budgets, supports DMCI's order book and cement demand. New airport, rail, and flood control projects due online in the next 2 to 3 years should drive DMCI Construction's revenue and the new cement unit. Growth projects, expansion in renewables, wind power, and mining, new nickel projects provide growth levers. Subic Water's earnings surge, 291 million pesos in 2024, and water franchise renewal adds stable cash flow. The Cemex deal, once stabilized, could add another profit center in building materials. Valuation upside. After a profit dip in 2023 to 24, shares trade at more moderate multiples. If coal and power prices recover or construction activity picks up, earnings could beat expectations, offering capital gains beyond the dividend. Reasons to hold DMCI. Steady, medium growth. DMCI is not a high-flying tech stock, but a steady conglomerate. Investors may hold to collect dividends and ride gradual growth. Its ROE, around 15%, is solid, suggesting average returns over time. Those with an existing position might keep it as a core infrastructure/housing play given DMCI's solid balance sheet. Diversification benefits. Its diverse mix and strong stakeholders, Kansunji family, Ayala, etc., make it reasonably safe from any single sector downturn. If you expect moderate GDP growth and some commodity stability, DMCI should hold its ground. In particular, DMCI Homes' pipeline of future condo projects and ongoing mining deals suggest room for a rebound if market conditions improve. Yield maintenance. If you value dividend income, holding DMCI makes sense as long as the payout policy remains generous. The company has a track record of raising or sustaining dividends in good years, 1.44 pesos per share in 2023. Even if growth stalls, the cash-generative businesses, water and power, should support payouts. Reasons to sell DMCI. Profit volatility. Earnings have proven cyclical. Net income plunged from 31.1 billion pesos in 2022 to 19 billion pesos in 2024. If coal prices stay weak or cement integration costs remain high, Q1 2025 cement loss of 546 million pesos. Profits may disappoint again. Short-term investors fearing another downturn might exit. High costs and goodwill. The Concreate acquisition has already brought heavy charges, both cash loss and non-cash goodwill. DMCI took around 1.9 billion pesos goodwill write-down on the cement purchase in early 2025, reported last April 2025. These hit book losses, even if one time, can spook investors. If the company's book value drops or it issues debt for Capex, cautious investors might sell. Construction slowdown. In the near term, government project delays or slower private building amid rising interest rates could hurt the construction and materials segments. DMCI Construction's profit collapsed in Q2 2025, 18 million pesos versus 250 million pesos prior. If you believe the Philippine economic cycle is turning down or that other contractors will grab market share, you might reduce exposure. Opportunity cost. If overall markets or other sectors like tech or consumer staples are performing better, investors may rotate out of cyclicals like DMCI. DMCI Holdings remains one of the most interesting dividend stocks in the Philippines, a true conglomerate with exposure to construction, real estate, power, mining, water, and now cement. Its strengths lie in diversification, solid balance sheet management, and consistent dividend payouts. But like any cyclical company, it faces challenges, from volatile commodity prices to integration risks in its new cement venture. At the end of the day, DMCI is not a get-rich-quick stock, but it is a long-term, income-generating play tied closely to the Philippine growth story. If you found this video helpful, don't forget to like, share, and subscribe to Thrifty Finance Vision PH. Hit the notification bell so you won't miss our next deep dive on Philippine stocks and investments. And let us know in the comments, what are your thoughts on DMCI Holdings? Do you see it as a buy, hold, or sell? We'd love to hear from you.